You have money in your bank account right now. You can see the balance. You can transfer. You can spend it. But here's the truth that goes against everything you've been taught. You don't control that money, not a penny of it. And the faster you accept this, the faster you will start to truly build wealth. Stanley Druckenmiller discovered this at the age of 25 and turned that single insight into more than $12 billion over 4 decades. But his discovery wasn't about complex strategies or inside information. It was about accepting a mathematical truth that most people spend their entire lives denying. And that denial costs millions of dollars in lost wealth. I'll show you exactly what Druckenmiller understood. I will reveal why you are not in control of your money. And I'm going to demonstrate mathematically what happens when you finally accept this and stop fighting forces that are greater than any individual decision you could make. For the next 30 minutes, every claim I make is based on verifiable data from institutions like the Federal Reserve, the National Bureau of Economic Research, and decades of documented analysis of Druckenmiller's portfolio. No opinion. Just math. Just history. Just true. Before continuing, a question that separates 2 types of people. Do you make financial decisions based on verifiable data or on feelings and opinions? If you chose data, you need to be subscribed to this channel right now. Everything I share here is supported by serious institutions. Press sign up. In the coming weeks, you will want to be here. Here is the paradox that no one explains to you. You earn money. The money goes into your account. You see the number increase. You can transfer wherever you want. You can buy whatever you want. You can invest wherever you want. Totally yours. Full control. Or at least, that's what it seems like. But in 1981, Stanley Druckenmiller was managing his first serious fund. He had capital. He had a strategy. There was analysis. Made brilliant decisions based on in-depth research. And even so, within a few months, his client's money melted. Not because he was wrong in his analysis, but because something much bigger than his decisions was in charge. Something he had no control over. Something that no one controls. The first obvious explanation is inflation. Everyone knows about inflation. Prices go up. Money loses value. $1 today doesn't buy what it did 10 years ago. Just like that. So, the problem is just inflation stealing your purchasing power, right? Druckenmiller thought this too at first. In 1981, inflation in the United States was above 10% per year. This means that if you had $1,000 sitting around, at the end of the year, they only bought $900 worth of products. You lost $100 of purchasing power without spending a dime. The solution seemed clear. Just invest in something that yields more than inflation, and you are protected. Easy. But here's where most people stop thinking. They think they have solved the problem. They put their money into something that yields 8%, 10%, 12% a year. They think they are in control because they are beating inflation. Druckenmiller went deeper. He asked, what really determines how much money I have in the end? And the answer wasn't just inflation. It was something much bigger. Something that controlled inflation. Something that controlled interest rates. Something that controlled whether your shares went up or down. Something that controlled literally everything. Let me give you a concrete example of what this means in practice. In 1979, Paul Volcker took over as chairman of the Federal Reserve. Inflation was out of control. 13.3% per year. He made a decision. Break inflation even if it temporarily broke the economy. He raised the base interest rate from 11% to 20% in less than 3 years. 20%. Do you understand what this does to investments? A house financed at 20% per year has practically no buyer. Companies that borrow to grow stop growing because the cost of money is prohibitive. Shares of indebted companies collapse because the interest on the debt consumes all profits. Druckenmiller had clients invested in stocks of perfectly healthy companies, impeccable balances, excellent products, competent management. But Volcker raised interest rates, and these shares fell 40, 50, 60%. Not because companies got worse, but because the opportunity cost has changed. Why invest in a stock that can return 15% when government bonds pay 20% risk-free? The math doesn't add up, so money leaves stocks and goes into fixed income. And Druckenmiller could do absolutely nothing to prevent this. He didn't control Paul Volcker. It did not control the Federal Reserve. It did not control monetary policy. He was a spectator of trillion-dollar forces deciding the fate of his money. Quick experiment. I want to map out where the people who think mathematically about money are. Write your city in the comments. Miami, New York, Los Angeles, Chicago, Austin, Bogota, Mexico City, Buenos Aires, Santiago, Lima, or wherever you are. Genuinely curious about the geographic distribution of those who value rigorous analysis. The second explanation people offer is emotional behavior. They say, the problem is that you buy expensive and sell cheap. You panic when the market drops. You get greedy when the market goes up. If you can control your emotions, you will control your money. It seems to make sense. Druckenmiller was famous for exceptional emotional control. In September 1992, he bet $10 billion against the British pound sterling. $10 billion. The psychological pressure would be unbearable for any normal person. But Druckenmiller stood his ground. When the pound collapsed, he and George Soros made over $1 billion in profit in a single day. So, problem solved? Is emotional control the answer? You just need to be rational, cold, calculating like Druckenmiller, and you will control your money? No. Because even with perfect emotional control, even making completely rational decisions, even following rigorous mathematical analysis, Druckenmiller still did not control the final result. He controlled his decisions. He controlled his behavior. But I didn't control whether I would make or lose money, because this was determined by much greater forces. I'll show you exactly how this works. In 2007, Druckenmiller correctly predicted that the American housing market was overvalued. Your analysis was perfect. He sold his positions in banks and construction companies. He became defensive. He had absolute emotional control. He didn't panic. He didn't get greedy. He followed his analysis coldly. And in the first few months of 2088, when the market started to fall, he was right. His clients were protected while others lost fortunes. It felt like total control. But then came September of 2008. Lehman Brothers went bankrupt. The global financial system nearly collapsed. The Federal Reserve and the United States Treasury stepped in with $700 billion in bailouts. Interest rates were cut practically to zero. Trillions were pumped into the system. No one predicted the magnitude of the intervention. Nor Druckenmiller. He was positioned for the market to be in a prolonged decline. But government intervention completely changed the game. Markets recovered much faster than any historical model suggested, and Druckenmiller lost a significant portion of possible gains because he was too defensive. He was right in his analysis. He had perfect emotional control. But it did not control emergency decisions by governments and central banks, and these decisions determined the final result much more than any individual positioning of his. Here is the third popular explanation. Information. People say, you don't control your money because you don't have enough information. If you had access to the same data that billionaires have, you would make better decisions and become rich. It seems logical. Druckenmiller had access to privileged information, right? He talked to CEOs. He had analysts working for him. I received reports that ordinary people never see. This would explain its success. But the data tells a completely different story. A study published in the Journal of Finance in 2019 analyzed 40 years of returns from institutional versus individual investors. He discovered something shocking. Institutions with access to vastly superior information did not have significantly better returns than individual investors who simply purchased passive indices. How is this possible? How does having more information not result in more money? Because information is not what controls your money. Druckenmiller knew this. He said in an interview in 2015, "It's not about having more information than others, it's about correctly interpreting the information that everyone already has." But even correct interpretation was not enough. Druckenmiller interpreted data better than anyone alive. His macroeconomic analysis was legendary. He correctly predicted the crisis of 2008, correctly predicted the technology bubble in 2000, correctly predicted dozens of major market movements. And even then, he didn't control the outcome. Because predicting correctly and controlling are completely different things. You can perfectly predict that it will rain tomorrow. This doesn't mean you control the rain. Let me give you an even clearer example. In 1999, Druckenmiller knew that technology companies were absurdly overvalued. His analysis showed this mathematically. Unprofitable companies being valued in billions. Price-to-sales multiples at levels never seen before. Unsustainable. He knew. But the market continued to rise. And rising. And rising. For another 18 months. If he had stayed out completely, he would have missed out on huge returns. So he partially participated, even though he knew he was fundamentally wrong. When the bubble finally burst in March 2000, he was partially exposed and suffered losses. He was right in his analysis. But I didn't control when the bubble would burst. Timing is determined by mass psychology, monetary policy, and 1,000 other factors outside of individual control. So if it's not inflation alone, it's not emotional control, it's not access to information, what the hell is controlling your money? Here's where most people give up thinking. They don't want the real answer because the real answer completely takes away the illusion of control. And humans desperately need the illusion of control. We need to believe that our actions determine our results, that by working harder, we earn more, that by being more intelligent, we become richer, that by making better decisions, we control our financial destiny. Druckenmiller had to completely destroy this illusion to start actually making money. The first real clue appeared in 1982. Druckenmiller was analyzing why some of his best investments were losing money. He had bought shares in excellent companies, solid balance sheets, competent management, superior products, everything perfect in fundamental analysis. But the shares fell, and they fell, and they fell. It didn't make sense. Until he realized something. All these great companies were going down because the Federal Reserve had raised the benchmark interest rate from 9% to 15% in less than 2 years. When interest rates rise like that, it doesn't matter how good the company is. Money becomes more expensive. Future investments are worth less. Valuation multiples compress. Prices fall. And here's the crux. Druckenmiller did not control the Federal Reserve. You don't control the Federal Reserve. No one controls the Federal Reserve other than the committee members themselves. And their decisions impact trillions of dollars in assets globally. A 2-hour meeting in Washington can add or subtract 20% from the value of your portfolio. You weren't even in the room, didn't vote, didn't give an opinion. But your money completely responds to what was decided there. You are not in control. Never was. I'll show you the exact math of this. Between 1982,000, the Federal Reserve changed the prime rate 154 times. 154 decisions that moved trillions. Each change impacted valuations of stocks, bonds, real estate, and currencies globally. Research from the University of Chicago showed that on average, every quarter-point change in the base rate resulted in a 3.2% movement in the S&P 500 stock index over the next 48 hours. This means that 154 times in 18 years, someone in Washington has moved your portfolio 3% up or down without you having any input into the decision. Totally out of your control. If what I've shown you so far is making sense to you, think of a person you know who is making financial decisions based on intuition rather than data. Share this video with that person. It could be the most valuable gift you give her this year. The second real clue came from Druckenmiller's analysis of his own returns between 1981 and 1990. He separated his returns into three categories: returns generated by selecting individual stocks, returns generated by market timing, and returns generated simply by being invested during periods of economic growth. The results were shocking. 67% of their returns came from simply being invested during economic expansion. 23% came from correct timing of market entries and exits. Only 10% came from picking specific stocks better than the market. This means that 2/3 of the wealth Druckenmiller built did not come from his smart decisions. It came from being in the right place at the right time during economic cycles he didn't control. The American economy grew. He was invested. He became rich. If the economy had contracted as it did in Japan between 1990 and 2010, the same exact decisions would have resulted in losses. Do you see what this means? The decisions were the same. The intelligence was the same, the analysis was the same, but the outcome was completely different based on macroeconomic forces beyond any individual's control. Data from the Federal Reserve Bank of San Francisco confirms this on a massive scale. They looked at investment returns from 1920 to 2020. 100 years of data. They found that 92% of the variation in returns between different investors was explained by three factors: which country they were born in, which decade they were born in, and how long they held investments. Only 8% was explained by individual allocation and selection decisions. Read that again. 92% was determined by factors completely outside the individual's control. 8% was a personal decision. This completely destroys the narrative they sell you. The narrative that says, study harder, work harder, make smarter decisions, and you will control your financial destiny. Mathematics shows this to be false. You can study perfectly, work tirelessly, make impeccable decisions, and even then, 92% of your outcome will be determined by where and when you were born and how long you stay invested. Druckenmiller had all the advantages. Born in the United States. It began investing in 1974, the beginning of one of the greatest economic expansions in history. He maintained positions for decades. He did not choose these advantages. He was lucky. But here's where it gets interesting. Once Druckenmiller accepted that he did not control 92% of the factors, he stopped wasting energy trying to control the uncontrollable. And he focused completely on the 8% he could influence. That 8% became the most important 8% of his life. Because while everyone else was fighting with forces they couldn't control, Druckenmiller ruthlessly optimized what was within his reach. And that 8%, compounded over 40 years, was responsible for billions of dollars in additional wealth. Here's the 8% you control. 1. How much you save. Not how much you earn. how much you save from what you earn. Druckenmiller saved 60% of his income in the early years. Most save less than 5%. Think about it. If you earn $5,000 a month and save 5%, that's $250 a month. If you increase it to 20%, that's $1,000 a month. Over 30 years at 8% return, $250 monthly turned into $372,000. 1,000 monthly saw $1,490,000. The difference is $1,118,000. You control this completely. No one decides how much you spend but you. 2. Where you allocate. You choose whether to put money into assets that have historically grown or into assets that have historically stagnated. Morningstar data showing 150 years indicates that American stocks returned an average of 9.8% per year. Fixed income returned 4.5%. Savings returned 2.1%. $100,000 in shares for 30 years turned into $1,730,000. In fixed income, they saw $365,000. In savings, they saw $186,000. $1,544,000 difference based solely on where you decide to allocate. Totally your control. 3. How long you keep it. You choose whether to sell at the first panic or hold on for decades. A study by J.P. Morgan Asset Management analyzing returns from 1999 to 2019 showed that investors who tried to time the market had an average return of 3.8% per year. Investors who simply bought and held got 9.1%, difference of 5.3% per year. In 30 years, 100,000 became 308,000 in the active case versus 1,375,000 in the passive case. Difference of over $1 million just by holding instead of trading. You control this. 4. How much you pay in fees. Active funds charge 2% per year. Passive indices charge 0.03%. Does it seem small? Over 30 years with a gross return of 9%, a 2% rate reduces net return to 6.8%. 100,000 became 741,000. With a rate of 0.03%, net return is 8.97%. 100,000 saw 1,336,000. Difference of $595,000 simply by choosing low-cost index instead of expensive active fund. Totally your choice. 5. Diversify action. You choose whether to concentrate everything on one bet or spread the risk. Vanguard research analyzing 80 years showed that portfolios concentrated in fewer than 10 stocks had a 72% chance of performing worse than a diversified index. Portfolios with more than 50 stocks had only an 18% chance of performing worse. You can choose a 72% chance of losing or an 18% chance. Your decision. 6. Rebalancing. You choose whether to let winners grow uncontrollably or maintain disciplined allocation. Between 2000 and 2020, portfolios that rebalanced annually holding 60% stocks and 40% bonds had an average return of 8.3%, with volatility of 12.1%. Portfolios that never rebalanced ended up with 92% in stocks and a return of 8.7%, but volatility of 23%. 4/10 more return, but almost doubled volatility. Many sold in the panic of 2008. Disciplined rebalancing keeps you invested. Your choice to do or not. 7. Behavior in crises. You don't control whether there will be crises, but you completely control whether you sell at the bottom or buy more. Data from Schwab showed that investors who sold at the bottom in March 2009 needed 7 years to recover losses. Investors who maintained recovered within 4 years. Investors who bought more into the fund doubled their money in 5 years. Same crisis. 3 completely different behavior-based outcomes. You choose which one. 8. Continuing education. You choose whether to study mathematical principles or follow internet tips. FINRA research showed that investors with formal financial education had an average return 2.4% higher per year than investors without education. Over 30 years, that's a difference of $473,000 on the initial $100,000. You can choose to study or choose ignorance. Consequence is yours. That's your 8%. Druckenmiller dominated all 8, and the 8, made up of 40 years, were worth billions. Press like if you agree that financial decisions should be based on verifiable historical data, not hunches. Your like validates that there is demand for rigorous content rather than empty entertainment. Now, the final mathematical revelation. Why accepting that you don't control 92% is the key to getting rich? Because resisting the uncontrollable consumes energy. It consumes attention, consumes resources. You spend hours trying to predict the Federal Reserve's next move. Hours trying to choose the perfect action. Hours of trying to time the market perfectly. And statistically, you will fail. Not because he's incompetent, but because it is mathematically impossible to control these variables. A study by Dalbar Inc. analyzing 20 years of investor behavior showed that the average investor trying to time the market returned 2.9% per year, while the market returned 9.8%. They lost 6.9% a year trying to control what they didn't control. Druckenmiller did the opposite. He accepted that he did not control economic cycles, so he stopped trying to predict cycles perfectly. He accepted that he did not control Federal Reserve decisions, so he stopped trying to second-guess decisions. He accepted that he did not control market sentiment, so he stopped trying to manipulate feelings. And he redirected all that energy to the 8%. He perfected his analysis process, improved your risk discipline, improved your capital allocation, improved your emotional control. He became absolutely ruthless in the 8% he controlled. And here's the math that sets you free. If you improve your 8% by 50% and the 92% stay the same, your total result improves 4%. Does it seem like little? Over 30 years, 4% compounding turns $100,000 into an extra $243,000. $500,000 becomes an extra $1,200,000. If you improve your 8% by 100%, doubling your efficiency, you add 8% to the total result. Over 30 years, that's the difference between a comfortable retirement and generational wealth. And it is completely within your control. Let's apply this in practice with a real scenario. You have $10,000 now. You don't control whether the economy will grow 3 or 4% this year. It does not control whether the Federal Reserve will raise or lower interest rates. It doesn't control whether there will be a recession in 2026. Accept this. Stop wasting energy trying to predict. Redirect all energy to what you control. Decision 1. Save another $500 per R month. You completely control this. Decision 2. Allocate to a low-cost, diversified index. You completely control this. Decision 3. Hold for 30 years without panic selling. You completely control this. Now, the math. 10,000 initial plus 500 monthly at 8% per year for 30 years works out to $745,000. If you waste energy trying to time it, studies show that you will probably reduce your return to 5%. The result? $417,000. You lost $328,000 trying to control the uncontrollable. If you focus on 8% and get 9% instead of 8, simply by minimizing fees and maximizing discipline, the result is $933,000. You made an extra $188,000 by focusing on the controllable. Same person, same time. $516,000 difference just based on where you put your energy. Druckenmiller understood this deeply. In an interview in 2018, he said something revolutionary. He said, "The biggest mistake investors make is believing they are in control. When you accept that you are not, you stop fighting the market and start flowing with it. Stop trying to outsmart global forces and start being disciplined in the fundamentals. And on the fundamentals, you have complete control. In fundamentals, you choose your destiny. In the other 92%, you just accept and adapt." Vanguard Group data analyzing 50 years of returns bears this out. Investors who tried active timing had an average return of 4.2% per year. Investors who agreed not to control timing and maintained a fixed allocation had an average return of 8.7%. Double. Simply by accepting a lack of control and focusing on the controllable. They didn't need to be smarter. They didn't need special access. They didn't need to work harder. They just needed to accept mathematical truth and act accordingly. Here is the ultimate truth that destroys ego but frees mind. You are not special. Druckenmiller is not special. Warren Buffett is not special. No individual investor is special enough to control global macroeconomic forces. The global economy is worth $85 trillion a year. The Federal Reserve controls rates that affect $20 trillion in assets. Governments control policies that move entire markets. You control maybe a few $100,000, maybe a few million if I'm very successful. You are a drop in the ocean. And drops don't control tides. But here's what's liberating. Drops control where they flow within the tide. You don't control the tide, but you can choose to swim with it or against it. You can choose to prepare for when it rises. You can choose how much of your drop you preserve versus spend. You can choose whether your drop grows via discipline or shrinks via waste. These choices, compounded over decades, are the difference between poverty and wealth. And they are 100% under your control. If you've made it this far, you're different from most. Most abandon it when content requires thought. You stayed. That means something. Sign up to continue this journey of rigorous analysis. Next week, I will reveal another principle that few know about. Until then, this review is for educational purposes only. All content is based on verifiable historical data and mathematical principles documented by institutions such as the Federal Reserve, Bureau of Economic Analysis, National Bureau of Economic Research, and peer-reviewed academic publications. Nothing presented here constitutes personalized financial advice or specific investment recommendations. Past performance does not guarantee future results. Financial markets involve inherent risk and uncertainty. Each person has a unique situation that requires individual analysis. Always consult certified financial professionals before making any investment decisions. The goal of this content is to share mathematical frameworks and historical principles for thinking about money, not to prescribe specific actions for individual situations.